Good afternoon, all. I'm Raymond Dahlman, host of the Liberty Call. Today is Thursday, January 20th, 2022. Hope everyone's having a fantastic Thursday out there in the interwebs. It is a beautiful day here in Colorado after 3 days of, just gloominess. It reminded me a lot of, the winters in Texas and Florida where it's just overcast and gray, a little drizzly, which drizzle when it's 20 is not good because it glazes everything over. So there were a lot of complaints over the last couple of days here for people slipping all over the roads. And I know when I went out earlier today to go run to town real quick, I'm slipping on the driveway, even in my boots. So it's not fun. But got sun out today. It's melting all the ice off everything. I only had to sit in my truck for about 10 minutes for the windshield to unglaze over. So anyways, like I said, hope everybody's having a great day. Kind of an ugly day in the stock markets. It looked really good most of the day. It was up, 300-400 points. And, just this afternoon, just went to crap. So, I think the jobs report probably had something to do with that. It was not ideal. Probably if I dig through more of the news, I could probably find some more reasons that the market was not cooperative today. All right, well, let's go ahead and jump in, take a look and see how things were today. Dow Jones closed down 0.89 to 34,715. S&P 500 was down 1.13%, closed at 4481. NASDAQ was down 1.3%, closed at 14,154 even. And small caps were down 2.04%. The VIX went up another 7.3% today to close at 2559. Again, remember, pay attention to the VIX when it gets up near 30. That's when you might want to start heading for the lifeboats or taking evasive action with your portfolios. That's just my opinion. You do what you want, but that's a number I personally use. All righty. Across Europe, kind of mixed. I see red and green, mostly greens. So that's pretty good. Getting down to the Asian markets and the other side of the world, kind of back and forth. Looks like the Hang Seng was up 3.4% and the China A50 was up 1.77. So much better day in Asia than it was, and also in Europe than it was here in the United States. Those things happen. So, if I were to take a guess, I would imagine when the Asian markets open, they'll probably be down because a lot of times, one market affects the other around the world. Okay, got a couple articles I want to cover. First one, the Fed may run fast on long road to normal balance sheet. I know I spend a lot of time talking about what the Fed's actions are doing. The reason why is because it affects our daily lives. What the Fed does with our money makes life either more expensive or less expensive for us. And, over the last 2 years, creating, 25% more money in the money supply, it's going to do that. It's going to create, where fuel costs are going to go up, food. Everything is interconnected. So when fuel costs go up, that affects the costs of, raising animals and growing food, shipping it to market. So, we're feeling it in our pocketbooks. And, for those a little higher on the income spectrum, that pinch isn't nearly as bad. But for those, I was down at the bottom of the food chain, 20 years ago. I know what it was like, having to get by on, not a whole lot. And, so that's why I get really pissed about this stuff. So, all right, let's go ahead and read this, written by Howard Schneider from Reuters. As part of its battle against inflation and to return to more normal monetary policy, the U.S. Federal Reserve is approaching a decision to reduce its balance sheet, which roughly has doubled in size during the pandemic to nearly $9 trillion. It's a huge stockpile that has been helping hold down longer-term interest rates, including the mortgage rates households worry about when they buy a home, and which influences a wide range of assets and other prices in the economy. It has been a long journey to a balance sheet that big, and it will be a long trip back to whatever level assets the Fed decides is normal, quote unquote, for it to hold. For most of the Fed's history, its footprint in government bond and securities markets was small and steady. That changed in 2007 when the central bank first relied on quantitative easing or purchasing large amounts of government debt as a way to funnel cash into the financial system. The balance sheet has evolved since then and in distinct stages, and officials are about to open the next chapter as they debate how fast to pull back from the key markets for U.S. Treasury and mortgage-backed securities. The prospect, along with the Fed's plans to raise its short-term policy rate as well, is already prompting financial markets to reprice the rates that households, companies, and the government itself pay to borrow money. Policymakers haven't decided how fast to make the drawdown this time. The Fed Chair Jerome Powell said only that they will go faster through the endpoint also remains unclear. The last time the Fed attempted quantitative tightening, it pulled a maximum of $50 billion a month from the financial system. Analysts are penciling in bigger numbers, with Oxford economics chief U.S. financial markets economist Kathy Bostajancic anticipating a $90 billion per month pace. The financial system can tolerate an accelerated reduction in the Fed's holdings of securities, with perhaps $1.8 trillion of excess liquidity sloshing through the financial plumbing. She wrote this week, we look for the Fed to be aggressive. So that is up for debate. Is the Fed going to stick to what they say they're going to do? Are they actually going to start rolling these securities off their balance sheet and shrinking the money supply? I don't know. Will they, be true to their word and raise interest rates 4 or 5 times like it's been said? Jamie Dimon at Chase seems to think there's going to be 8 or 9. I think I said yesterday. So it's going to be interesting. The true test will be the first time we have some sort of little rumbles or aftershocks in the economy. Either labor or the unemployment rate starts to rise, or the market starts to wane, which is a distinct possibility with the tightening of the money supply. So we'll see. The first time they hit a bump in the road, are they going to turn around and head back for safety, or are they going to continue to get the economy back on track? So personally, I think they're spineless cowards and will do whatever they need to do to save their jobs. But that's just me. All right. Next article here. U.S. jobless claims rise to 3-month high. This is written by Emily McCormick. All right. Weekly new jobless claims unexpectedly jumped last week by the most since October, with some renewed virus-related disruptions, at least temporarily impeding the labor market's recovery. The Labor Department released its latest weekly jobless claims report Thursday at 8:30 a.m. Here were the main metrics from the print compared to consensus estimates compiled by Bloomberg. Initial jobless claims for week ending January 15th were 286,000 versus the forecast of 225, and they revised up last week's up to 231. We'll check on that tomorrow and see what the previous number was. Continuing jobless claims came in at 1.635 million against a forecast of 1.563 million. So what is that, about 70,000 higher, and a revised 1.551 million for the prior week. Initial unemployment claims rose for the third straight week, coming in near the 300,000 level. This represented some backsliding from recent progress and trajectory of jobless claims. Claims have reached a 52-year low of 188,000 in December. I think that's probably a 52-week low. 52-year just seems too high. As many employers attempted to keep their existing workforces in face of widespread labor shortages. Continuing claims also came in higher than expected in the most recent data. These claims, which track filers still collecting regular state unemployment benefits, rose by more than 1.6 million in mid-January. Still continuing claims had come in at the lowest since 1973, just a week earlier. The most recent move higher in new claims may be bad due to some impacts from the Omicron variant, and ultimately proved temporary. According to some economists, after having notched the lowest levels in decades, new claims are moving in the wrong direction. Omicron deserves suspicion for some new job losses, with pressures being seen both on the labor demand and supply sides, said Mark Hamrick, Bankrate senior economic analyst, wrote in an email Thursday. Because of the pandemic, some workers have been sidelined, and no doubt some businesses have been negatively impacted by the latest wave of the pandemic. And even without the latest pressures from the virus, the labor market already had already been considerably tight heading into 2022, representing one of the many supply side challenges for companies. Transportation and labor markets remain tight. Availability of materials remains stretched in some categories and in some markets. Inflationary pressures are broad-based with little signs of near-term relief. Procter & Gamble Chief Financial Officer Andre Schulten said during the company's earnings call Wednesday. Still, competition for labor has also presented opportunities and additional leverage for workers. Wages last rose 4.7 on an annual basis in December, according to the latest monthly Labor Department data. And some of the biggest corporations in the U.S., including J.P. Morgan and Goldman Sachs, have already reported higher compensation costs in their latest quarterly results, largely as a bid to attract and retain talent. The consumer has $2 trillion more on their balance sheets. Their home prices are up. Asset prices are up. Jobs are plentiful. Wages are going up, which is good for them. J.P. Morgan CEO Jamie Dimon said during the firm's earnings call last week, "We're not against that. The consumer is really in good shape." So, that is some good news and some bad news. Obviously, I do pay attention to how the employment numbers are week to week. So it is a little disheartening that, as we head into the last few weeks of January, that we're heading into the wrong direction. But, the jobs are out there. I don't really know what to tell people who aren't employed or aren't receiving the income they think they deserve. All right. Next article: rising mortgage rates squeeze both homeowners and buyers. Written by Gabriela Cruz Martinez. All right. Mortgage rates surged this week on inflation concerns, hitting the highest point in 22 months. That sent home buyers scrambling to lock in rates. Many home buyers, on the other hand, face a shrinking opportunity to refinance. The rate on 30-year fixed rate mortgage, the most common home loan for buyers, increased from 3.56 to 3.45 last week, according to Freddie Mac. That is the highest rate since the third week of March 2020. The 15-year fixed mortgage rate, a popular refinance choice, similarly increased to 2.79 from 2.62. Mortgage rates have moved up again as the 10-year Treasury yield rose and the financial markets adjusted to anticipated changes in monetary policy that will combat inflation. Sam Kater, Freddie Mac's chief economist, said in the statement. Fixed mortgage rates tend to follow the yield on the 10-year Treasury, which has jumped to the highest levels since December of 2019 on expectations that the Federal Reserve will make moves, including hiking short-term benchmark rate to tame inflation. Buyers rush to beat the quickly rising mortgage rates. Despite the winter season, when housing activity is rather dormant, homebuyers this year have remained in the market to take advantage of current rates before they increase further. According to George Ratu, Realtor.com's manager of economic research. Perhaps applications rose last week as buyers rushed to beat the quickly rising mortgage rates, Ratu said. The volume of mortgage applications to purchase a home increased 8% last week, according to the latest index reading from the Mortgage Bankers Association. Other headwinds in the market, notably low inventory, fierce competition, and rapidly rising prices, also forced buyers to move forward now despite higher rates. For homeowners, the chance to refinance into a lower rate may have been passed by them. The volume of refinance applications slipped 3% last week, according to the MBA, and stands 49% lower than a year ago when the 30-year fixed rate mortgage was 2.77% and the 15-year rate was 2.21%. Refinance activity is at its slowest pace in over 2 years, according to Joel Kahn, MBA's Associate Vice President of Economic and Industry Forecasting. On top of that, refinance organizations are projected to drop to $870 billion this year from an estimated $2.32 trillion in 2021, according to the MBA's mortgage market forecast for year-end 2021 and 2022. The number of potential refinance candidates fell to 7.1 million in the second week of January due to higher rates, according to figures mortgage technology and data provider Black Knight gave Yahoo Money, down from 11 million in December. Still, 7.1 million U.S. homeowners could refinance and save an aggregate $2 billion monthly, or about $273 a month per borrower at today's rates, but that number is likely to shrink as the average 30-year mortgage is expected to reach 4% by the fourth quarter, according to MBA forecasts. A scenario where we reach that point, we could see a population cut in half yet again, with fewer than 4 million high high quality candidates remaining, said Andy Walden, Black Knight's vice president of enterprise research and strategy. So my advice to anyone out there who has been sitting around waiting to either buy a house or refinance their current mortgage, now may be the time. I don't think we're going to see rates down in the 2 and 3% anytime soon, especially with interest rates going up. I personally think we're going to probably see, if we're really going to squash this inflation, probably going to need to get up close to 10% or higher. I am not a interest rate expert. I just know enough to be dangerous. So also, a casualty of rising interest rates is we're probably going to see our home values slow down or even retrace a little bit, because home prices are in direct relation to interest rates. So as the interest rates go up, it makes it harder to sell homes for a higher price because you're paying more in interest, and it makes the mortgage payment much higher, which is what I'd say probably 80% of buyers typically how they buy a house. So they're looking at their monthly payment versus what the out the door cost is just to buy the house. Now, on the opposite side of that, for people who buy homes with cash, and it could actually be a good thing because you're not out there buying properties with loans. If you're a cash buyer, you're certainly probably going to welcome prices going back downward, and that might be good for those who have a lot of dry powder to work with. All right, next article. This mistake is costing you about $1,400, but you can fix it. This was written by Sam Lipscomb and was published on Tuesday, the 18th. Let's go ahead and breeze through this. A recent study done across several different age groups throughout the country revealed a troubling finding about financial literacy among Americans. The study, which surveyed a total of 3,389 adults, showed that the average adult loses about $1,389.06 annually due to lack of financial knowledge, including personal finance and investments. If you extrapolate these findings out to the entire country, this lack of financial literacy costs Americans estimated $352 billion in 2021. Many individuals in this study were found to have estimated losses in the tens of thousands over the course of their lifetime. However, while many Americans aren't as well versed in personal finances as they should be, there are lots of options available to help educate yourself on how to manage your finances more efficiently. Results of this, and I went and actually clicked to see what the study actually went through, and it had to do with things such as banking fees, getting loans with too high of an interest rate. So it's really money that's slipping through the cracks because you're either paying too much on a credit card interest rate, or maybe a bad credit, and you're having to pay risk-based pricing on your loans. So it's a number of things, but by tightening up your credit and also seeing where your money goes, you're able to be more efficient with your finances. All right. At the end of 2021, the National Financial Educators Council conducted a survey of 3,389 adults. Respondents were divided into 6 different age groups. The survey one only asked one question during the past year about how much money do you think you lost because you lacked knowledge about personal finances. The results were stark. On average, respondents estimated losing $1,389.06 in 2021 due to a lack of knowledge of personal finance. If you take that $1,389.06 and extrapolate it out to the entire population, it's about $350 billion in 2021 due to insufficient personal financial knowledge. On top of those findings, nearly 1 in 5 survey respondents reported losing more than $2,500 in 2021 due to a lack of personal financial knowledge. It's important to note that the estimates reported in these surveys may represent significant underestimates. Many people who lack financial capability may not even be aware of their losses. The lack of financial knowledge has consequences in people's day-to-day lives, including banking fees, higher interest rates on loans and credit cards, and investment losses. Right. There are plenty of possible explanations as to why Americans fall short when it comes to personal finance literacy. However, these results are nothing new, showing that the problem is persistent. For comparison, the same survey conducted in 2020 showed an average losses of $1,634. Another survey conducted in 2017 showed that the average reported lifetime loss due to financial literacy was $9,725, and 25% of respondents even reported losing over $30,000. Perhaps the most common and popular explanation for these losses and lagging personal finance education is the fact that schools don't usually teach children how to manage their money. That is the number one problem. I mean, I remember back in elementary school, you'd have these little tear out pennies and nickels and dimes and stuff out of your math book. And you had to learn how to count change. And, I remember they even taught us how to write a check in fifth grade math. As far as, what everything means on the check. And, I mean, maybe I just had a good teacher, but it's the financial literacy is a mess, and it's not that hard. I mean, it's just, especially with today's tools. I mean, we have so many online tools which download all your information, keep track of your books. I just don't understand why people don't do it. In 2020, Next Gen Personal Finance reported that some kind of a personal finance course is a graduation requirement in just 18.4 U.S. high schools. Most adults are left to their own devices when it comes to financial literacy. Another potential explanation is a lack of access to financial education resources like financial advisors. I doubt that. I mean, there's thousands of financial advisors, and I know most of us don't turn away business. So according to the study done in 2021 by Statistica, just 38% of Americans worked with a financial advisor last year, while 54% of Americans reported that they don't have a financial representation at all. Having a financial advisor to help you with your finances can be a big one when it comes to financially educating yourself. What can you do to prevent losing money? Simply put, the best way to avoid losing money due to a lack of personal financial knowledge is to learn more about how to manage your money in an advantageous way. Luckily, there's a handful of different ways to do so. One of the best and cheapest ways to learn about personal finance is to do some research. There are lots of sites out there with resources to help you learn about different terms and figures about how to manage your money. Smartasset.com has a number of different free online resources. They're actually a pretty good site. The site has articles on different terms about taxes, investing, and retirement. You can also use calculators that will tailor themselves to your specific financial knowledge. It's also a good idea to consider working with a financial advisor. I know a guy. Financial advisors are often financially trained professionals who can do heavy lifting for you while helping you learn about financial topics that you may be unfamiliar with. So, all right, that's about that. And then one last article. I'm not going to read through all this. For those of y'all who might be considering buying a Peloton bike or a treadmill, now's probably the time to do it because they are reportedly halting bike and treadmill production. Let's see here. I think Peloton plunged below its initial public offering price Thursday as the company is reportedly planning to stop production on connected fitness products amid waning demand. Peloton plans to halt production of its bikes for 2 months from February to March, CNBC reported, citing documents. The stoppage comes just a month after the company suspended production of its Bike Plus in December until June. Manufacturing of the Treadmill machine will also be halted for 6 weeks beginning in February, while production of the more expensive Tread Plus machines won't be resumed until fiscal 2022, according to documents. So, yeah, if you're in the market for a Peloton, this might be the time to do it. Or, if you want to, play your chances and see if you hold out for a little longer, maybe you can get one on sale while they're trying to get rid of inventory. So we'll see. All right. Well, that's everything I had for today. I only managed to ramble for 23 minutes. It is amazing. So hope everyone has a fantastic Thursday, and I'll be back tomorrow on Friday with the weekly wrap up. And if anyone needs anything from me, don't hesitate to shoot me an email or drop me a phone call. It's a clear day, so if you want to send some smoke signals, I might see them. I hope everyone has a fantastic night, and I will see you tomorrow. Bye.